Good evening, everybody. This is Rich Checkan, and I'm with Adrian Day, my co-host here for On the Move, our now 6 times a year or once every 2 month webinar. And we've got Lobo Tiggre connecting. He's having a little bit of difficulty connecting, but he's joining us here shortly. I just want to let you know we're here. Bear with us. He'll be with us in just a moment. In the meantime, I want to go ahead and share with you, we've already laid on our next guest. Which is going to be our next webinar is May 7th. That's a Tuesday night, a little change, a little departure from the norm, but it'll be 7 p.m. to about 8:30 p.m. And our guest is going to be none other than Peter Cavelti of Cavelti and Associates, somebody I've gotten to know through a relationship with my uncle and this company over the years, and somebody Adrian has known for many, many years. I don't know if you want to share any thoughts on Peter, Adrian.
No, Peter, I mean, I've known Peter, gosh, since the 1990s, just like your uncle. A Swiss guy, lived in Canada, well, lives in Canada for the last, I don't know how long, ever since I knew him, but he's Swiss originally. Very smart, very astute, got a broad view on both the markets, but also on the world. So I think it'll be very interesting.
Yeah, definitely. We're going to cover the macro big time, I think, with Peter, and he does that in his was it monthly newsletter, right, from Cavelti and Associates. Yeah. So I'll just start off.
That's next time.
Yeah, that's next time. Tonight, we've got none other than Lobo Tiggre. The first, I think y'all know Adrian. I'll introduce him here to you. He's born in London, schooled at the London School of Economics. And I always got to make sure I say that right, or I'm going to be very embarrassed. But an incredible mind when it comes to resource stocks, investing, et cetera, world stocks. He's not just confined to the resource world. His latest book is Investing in Resources. He's sought after from every pundit and conference and news channel you want to see, and if you hear him speak, you know why. I am very lucky to call him a friend as well. So,
well, thank you very much, Rich, and I'll introduce Rich again. Rich is a friend. I've known him probably 30 years. He's president and COO of Asset Strategies International, coin dealer based in Rockville, Maryland, and a very reputable coin dealer. And I knew his uncle. We talked about his uncle, who is the founder of the firm, and is the CEO of the firm today. I've known him even longer. So again, very, very happy to do this. I was very honored when you asked me to join you, and very, very happy to do it with you. While we're waiting for Lobo, why don't I take that first question, which is not on resource. So Lobo may have nothing, may not have much to say about it. What does Adrian think of secured lending companies like Ares Capital, for example? I'm going to sort of, if I may, narrow the question a little bit to business development companies, which Ares is one. Ares Capital is a business development company. As some of you listening will know, business development companies are a special kind of entity that lends money to small, medium-sized businesses, typically private, sometimes public, but they are required to, like REITs, they are required to distribute, it's 90% of their net investment income to shareholders as dividends, and in return, they don't pay any taxes at the corporate level. So that's the sort of structure, and that's what they do. Now, a business development company is simply a structure. So you can't say, I like all business development companies any more than you can say, I like all trusts or I like ETFs. It's a structure. And there's a wealth of a broad difference of different types of companies, from large to small, conservative to aggressive. Some invest only in technology companies, etc. So, but some of them I think are very, very good. Ares is a very, very strong one. It's the largest of the BDCs, and in my view, definitely one of the more conservative ones. Current yields over 9%, fully covered by net investment income. So I think when you're looking at these things with very high yields, obviously you're right to be suspicious or cautious. But remember, they don't pay tax at the corporate level, which is why the dividends, the yields tend to be high. But a couple of things you need to look for. One thing you need to look for with these is the distribution covered by income, and preferably by regular income, not by one-off events. Second thing I always look for is who does the marks on these. Remember, these are lending to private companies. You have to be very careful when a private company, when a company lends money to a private business and makes their own valuations up. So many of these companies will hire outside firms to do the valuations on their loans, and that's what you want to be looking at. But generally speaking, I think there's some great buys in that sector for people who just want income, consistent income over the long term. And Ares is a very good company. Anyway, enough on that. Lobo, we just started with a question which I didn't think you'd have anything to say about. You're welcome to add to it if you want. Let me introduce.
Sounds like you got it covered.
Let me introduce.
But I had to join with my Puerto Rican colors here. Like
Yes.
A couple of suits. Rich, what's up with the tie? I don't think I've ever seen you in a tie.
Oh yeah, no, at the conferences you do. Whenever
Okay.
speaking, I was told always wear a tie. Yeah, no, you come comfortable. We're here for your brain and your experience. No worries.
Let me just introduce Lobo to people who don't know him. My good friend and Puerto Rico neighbor, Lobo Tiggre. Many of you, some of you will know him as Louis James. He wrote under that name when he worked for Doug Casey, did a lot of recommendations in Doug Casey's newsletter. He's now on his own with a newsletter service, I should say, more than just a newsletter, called The Independent Speculator. And later on, he will tell us a little bit about should we say, the various streams of his particular service. But we're very happy to have Lobo with us. We're going to talk tonight, I think, about pretty much all things resource and anything else that he wants to talk about. But let me kick off with the first question, if I may, Lobo, and that is uranium. So congratulations and kudos, and I genuinely mean this, for getting that market right. You were in reasonably early. I think you have to be in early with resource stocks because when they take off, they can take off very quickly. But you got that right in what you told people. You also suggested taking some money, I think, recently when uranium hit $100 bucks. Now, so what are you saying now? What are you saying now to a person that perhaps doesn't own any uranium?
Well, music to the ears of that person in particular, but let me rewind just a second because it's important that actually my take on this has changed a bit recently. And by the way, I'm not a uranium specialist. I'm not a uranium guy particular. You know, Justin Hune over at Uranium Insider probably knows more than I ever will about the fuel cycle and all the details. But as a commodities speculator, looking at, and I'm a fundamentalist, looking at the fundamentals in that market, it was pretty obvious that either uranium would go up or the lights would go out in large parts of the world, as Rick Brule likes to phrase it, or another nuclear accident could have derailed it. But those are rare. That's not an investable premise, one way or the other. So if you take out the nuclear accident, then it was pretty obvious uranium had to go up. So yeah, I was early. But we got to a price well above what many of us would have been happy to have seen at the end. To quote Rick again, when he will take profits or exit a trade when it has met his speculative investment goals. So if he's already getting paid as much as he thought he would get paid, whether the market might still run or not, he's already looking to exit or at least recover his investment. So, those of us who've been waiting for uranium to take off for a while would have been happy to see $70, $80 a pound. And it blew right past that, over $100 a pound. And so in the first instance, whenever something goes like that, any experienced investor or speculator knows that no price goes vertical forever. The flavor du jour is cocoa. We can talk about that later if you want, talk about vertical. But, it's normal to expect at the very least some kind of breather after a chart goes like that. So I wasn't the only one to warn of correction. But I was the only one rude enough to do it on stage on the uranium panel at the Vancouver Resource Show. So we'll see if they invite me back again. But I was right. I was sitting there when that, the buzz of that conference was uranium. And I said, the prudent thing, well, gee, it's just gone vertical. There's nothing wrong with taking some profits here. And boy, did I get a lot of hate for that. I got angry emails and, and hairy eyeball, all kinds of things. No voodoo dolls on my doorstep, but I live in a protected building, so I'm not sure if that's real data or not. But jokes aside, I got a lot of pushback for that. And lo and behold, the correction came. And so that's the first point. It's just, it's normal for there to be a correction. Just on that basis, it's an opportunity for that hypothetical person you asked who missed the run back in 23 or earlier. But the second part of the story is like, okay, it's, correction was to be expected. The story isn't done, so there's opportunities there. But really, there's been market altering news. And to give credit again where due, Justin nailed this. I didn't. He was one of the experts saying that Kazatomprom was not going to be able to produce as advertised. And that is the world's not only the largest.
Sorry. Just set the stage for people who don't know.
Yes, that's where I'm going. Kazatomprom is not only the world's largest uranium producer, it's also the lowest cost producer. This is very important because, prices are determined at the margin. So if your lowest marginal producer is squozing, to use a technical term, that is market changing. There's that lower end of that range is gone now. And strikingly, so this is important. This is a really big player in this rather small market. And not only, not only are they having trouble ramping up as advertised, they have slashed now their guidance. There are pounds that were coming to the market that the market expected from Kazatomprom because they had guided this increase in output. But that's gone. They have basically said that their plans to ramp up, they're on hold. They're hoping just to be able to produce a little bit more this year than last year. And by the way, they didn't even produce as much in 23 as they did in 22. So never mind their big plan to increase production, they actually produced less last year. And they're hoping to recoup a little bit this year. And we'll see. They've got troubles that I won't get into the details because I'm not the expert there, but they, unlike most American producers, they use sulfuric acid in the ground ISR, in situ recovery mining method. It's one of the reasons why they're such a low cost producer. Again, I won't get technical. There are prices to be paid for this, but one of them is that you have to have sulfuric acid. And that has other uses right now, and supply chains have been broken by the war, so they're struggling. And this isn't just some junior fly-by-night sideshow. This is the world's biggest, lowest cost producer is struggling. So I was hoping that uranium might stabilize around 80 plus or minus, and then over the years ahead go upwards. We blew past that, corrected down to that, and now we have a change in the marketplace. Production that was expected isn't there, might be there in 26 if they can solve all their problems, which maybe they won't. So I'm sorry, that's a bit of a long-winded answer, but those two pieces are necessary. The answer to your question, to your hypothetical person, is I'm as bullish as ever on this. The change in the market makes me even more bullish in the near term than I would have been otherwise. Otherwise, had we gone up to 100 and corrected to 80, well, 80 that's more than enough to incent the lowest cost producers to come, back into the market, the lowest cost projects to get built. That's happening now. That's not a someday, inevitable or imminent thing. The projects that make money at lower prices than we have now, those are being built. That's happening as we speak. So before this change, I would have had doubts as to how sustainable the uranium price would have been in the nearer term, because we've reached an incentive price level. But now with the as we've just said, the biggest, lowest cost producer having troubles. And the second player, Cameco, they're guiding that they're going to ramp up and they're going to produce all this stuff, but their own ramp up hasn't been without problems either. So that's a show me, don't tell me. Even if they do, they're not the top dog. But if they don't, then that's even more cause for concern on the supply side. So I'm actually very bullish. If I had missed uranium before, then I would absolutely be willing to buy first stakes in the companies that have gone on sale since last month and really the month before it started. If I was already long uranium, I'd be looking around now. Okay, we've got a correction. Is there anything that I missed, or any great companies I didn't buy before that I'd like to have in my portfolio? And that's what I'm doing right now.
Okay, is it right that Kazatomprom is actually buying some uranium in the open market to fulfill his contracts?
That's not clear. What they said was, please don't worry, dear market. If necessary, we will do whatever we have to do to meet our contractual obligations. Like if we don't produce enough, i.e., they will go on the market. So they haven't actually said, yes, we're buying on the spot market. But the implication there is, nobody would say something like that if you didn't think that there was a reasonable chance that that might happen. But even if they don't, Cameco has said that they are and they will. And but the good news is that they've they never tell us these things. You have to figure it out afterwards, forensics on their financial statements. But their guidance says that they're talking triple digit contracts now. And people get angry at Cameco for their hedges. It takes it off the upside. Uranium bulls don't want to see, I guess, any bull. A gold bull doesn't want to see a gold company hedged, or a silver bull doesn't want to see silver hedges in their silver. So it's no different. But this is such a tricky business. And really, Cameco's business practice of hedging is what allowed them to survive when everybody else was going bankrupt. Everybody besides Kazatomprom was going bankrupt over the last 10 years. So can't blame them, can't say it's wrong. I mean, suppose there is another nuclear accident. Everybody else falls off a cliff. But the nuclear power plants that are not shut down are still going to need fuel. And Cameco, with their hedges, will still be able to sell it to them at prices then well above market. So I think it's short-sighted to beat Cameco up for that. That having been said, the fact is that we do know from them, the second biggest dog in the race, right, that they are buying on the market. And perhaps that's one reason why this correction, a lot of people were thinking it was going to fall back down to $60 or lower. It just waffled down into the 80s. It's been going sideways. If $80 to $90 uranium is the new normal, if that's the worst case scenario, that's actually fantastic. That is above the incentive price for even mediocre miners can make money at that price. So you know what? The uranium price doesn't even have to go up to make money in this space if you can find the better companies that can make money in this space as is. But I think the odds favor higher prices. I'll be very interested to see if Cameco can actually deliver 18 million pounds each at its two big operations this year. They say they're going to hit that level. We'll see. That's a tall order when everybody's been struggling with this. That's a show me, don't tell me.
Well, we could obviously talk for an hour and a half or actually more on uranium. Can I just ask you one more question maybe? And then
I've got a follow on as well too. So
go ahead.
I was just going to ask you, you talked about incentive price, you talked about new mines. Is there, in your estimation, at the current price, is there, can you sort of quantify, I don't mean in numbers, but just broadly speaking, how much new uranium we should expect to see in the next year or two? Or are we talking 4 or 5 years before new supplies come on?
No, we're talking a couple million pounds this year, but at the same time, we're talking about Kazatomprom yanking about 9 million pounds. So I think we actually see less new production this year if all goes well. I mean, there's companies struggling. I'm not going to name names. There's one American producer, would-be producer, that has contractual obligations to deliver this year that there's no way they're going to meet. They've been ramping up supposedly, and they're still only producing a couple 100,000 pounds. They're way behind. Other projects have, maybe no fault of the company's own. They've been delayed, have to replan. Basically, everybody except for Cameco is facing significant troubles and delays. And so that's another reason for me to say, show me, don't tell me. But the balance of production has never really been the only part to focus on, because there's always been secondary supply. Ever since the Japanese shut down the reactors, we've had all the secondary supply. So sorry, we don't want to take the whole hour and a half on this, but it's important to put that context in there, because really for many years, the mine supply has been in deficit. And it hasn't mattered, right? You know, mine supply was in deficit when we dropped to $18 a pound. Didn't stop the fall. But that's because they were secondary supply. So the important point there is that, you know, the Sprott Trust and other entities have really evidently hoovered up those cheap pounds that were hitting the market. So now mine supply does matter. And, you know, I had been, before the news from Kazatomprom, concerned that we might actually see a slight surplus this year, that new production coming along. And the people that bought pounds earlier to sell them at higher prices to finance their mine building, that those pounds might come back on the market. So I was concerned about the price in 2024. I'm no longer concerned. I think there will not, I cannot foresee a circumstance where the new mines coming on production or the old ones being dusted off will make up for the loss that Kazatomprom alone has just handed the market.
I've got first a comment. You mentioned that, you know, you spoke your mind and you said that you expected to pull back and nobody liked you and you've got a lot of hate mail.
I'm used to being disliked. I'm like that guy in 1776. Who was it? Obnoxious and disliked.
Yeah, I gotta say, you know, it's one of the things I love about you. So we've been bumping into each other for years, right? I think I ran into you, you know, a couple Doug Casey conferences in Bermuda, Arizona, New Orleans. We're on the panel, precious metals, that first night a few times. One of the things I love is you speak your mind. You're not a cheerleader. I'm not a big fan of cheerleaders. You know, gold ticks up $10 and everybody in the world is like, here we go. You know, that's not what it's all about. You talk about what your analysis proves out. It's one of the things I love about you. So that's my comment.
Well, thank you.
My question was, you know, you talked a little bit about this secondary supply. You know, uranium market investors have had the rug pulled out from them oftentimes in the past, right? Here we go, and then it's over because of an accident or because a bunch of new mine production comes online, or we tap into reserves. It seems like there's kind of a perfect storm coming here because that secondary supply really isn't there. And I'm talking about here specifically strategic reserves. They are depleted, are they not?
Well, depending on what you mean by strategic reserves, the DOE has some, the military has some. Of course, they're not going to tell you what they've got.
Yeah.
But those are not really liquid reserves. The DOE doesn't maintain that as a service to the utilities. That's a stockpile of their own for their own purposes. But by the way, there's a whole new entity here in that this started under Trump, and the Biden administration has continued it. There's bipartisan support for a new national uranium stockpile, a la strategic political reserve. I mean, petroleum reserve. And that is just getting started. So this isn't a source of secondary supply that can suddenly swamp the market. This is a new entity that's just being created, that's just in the last year started buying pounds to build supply in the first place. So the United States government, apart from its other consumption, and you know, we're never going to know what the military is buying, and you know that's gone. That's a black hole. But this is a visible source of new buying that was not part of the market before. So I know that in the investment world, there are a few words more dangerous than "this time is different." But this actually is a difference in the market. This is a substantial new buyer that simply didn't exist before. And they're
Certainly
looking to
seems
buy,
that way.
I'm sorry, the plan is to buy something like, I think the initial installment was 75 million. That's a lot of pounds, and then 150, and then to do that for like 10 years.
Certainly seems that way. So I don't know if you want to switch gears here, Adrian, or do you have a follow-on as well?
Sure, no, you carry on.
All right. So we're going to switch to my world a little bit. I want to kind of tap in here. Obviously, I'm in the gold and silver and precious metal world. We've seen a bit of a disconnect. Gold is starting to head for the hills, head for the sky, and the mining stocks aren't quite following suit just yet. Can you explain that? And what's the trigger to get stocks to catch up, if you will?
Sure. Okay. So the last one, and maybe most important, we'll save the best for last. But in the first place, the better stocks have moved. If you have a gold stock that has done bupkis since gold started hitting new all-time highs, nominal all-time highs, that's an important point too. In real terms, just using the government CPI numbers, never mind a more realistic number, an actual all-time high or a real all-time high would be over $3,400 right now.
Yeah.
So we're hitting nominal all-time highs. And yes, the gold stocks have underperformed, but your go-to stocks have moved. Your better mid-tiers and juniors have moved. Your profitable producers, the companies that have assets of merit, or even exciting exploration programs, they have moved. And dear audience, I'm sorry, but if you have a gold stock that hasn't budged at all in the latest trading, then the market is telling you something. It's not just the general market conditions. There is something wrong with that story. Now maybe you're a genius and you've spotted an overlooked gem that Mr. Market will figure out later. Or maybe, because this isn't the broader general market right now, this isn't the average investor, this isn't your shoeshine boy getting into gold. The only people in gold stocks now are industry insiders. And if they're not buying your precious gold stock, maybe you ought to reconsider your premises there on that thesis. I'm trying to be kind here. It's not too insulting, but
Honest works. Honest works.
This is how things work. It's an opportunity here to reevaluate your theses, and you can't fall in love with these things, as Doug Casey famously likes to say. These crappy junior mining stocks, they're burning matches. They're not family heirlooms. So first things first is, the stories that actually have something there, they have moved. So that is good. There's proof of concept there. Now, why are they still relatively on sale? And not just relatively, if you price them in gold itself, they're absolutely on sale. And I think that is a reasonable basis for pricing a gold stock. That's the business they're in, and it's real money. So why are they so on sale? My thesis on this is, and it's not something I can prove, but this is my take. It's not just recency bias, though the recency bias is that the last time gold spiked in 2011, it peaked, petered sideways a little while, and then went on a 5-year slide. So the industry, that's what their last experience with the gold dollar exchange ratio is. And I always call it that because gold is money, and I see gold and the dollar as a Forex transaction. And so calling it a price, I think, demeans the gold's nature as money. So, but it's not just that. If you look back, the other big time was, of course, 1980, which is in an even more vertical spike and in a more bigger correction. So the entire time since 1971, when Nixon closed the gold window, that gold has been freed from the dollar as a millstone and been able to trade. In that entire time, there are only 2 experiences that we have with big surges like this. And both times, there were spikes that led to multi-year declines afterwards. So it's not unreasonable for industry insiders to say, well, that's the experience in the entire history of this trading, the gold dollar pair. Yeah. So I think the stocks are leading the metal downwards. The industry is saying gold has spiked, the next big move should be down. Now, I think they're dead wrong. So the stocks are leading the metal lower, and they have in the past, actually. The stocks went down before gold did in 2011. I was not in the stocks in 1980. I was the shoeshine boy back then. But I remember in 2011 that the stocks led the metals lower. And to give credit where due, David Morgan called it early. He said silver is giving us a warning sign here. And I remember he called that. And I don't know if anybody else was that clear. At Casey Research, we did say that that the exchange ratios had risen too far too quickly, but we didn't really see what was coming next. And so, but the stocks did. The alligator jaws were opening then as well. The stocks were going lower than the metals. So I think that's what's happening now, is both recency bias and a longer term look at the sector says gold spikes, the next big move is downwards. So we're going to take our profits and move on. Now, I got to say, not only do I think they're wrong, I think it's very wrong-headed for them to even still be in that camp right now, because 1980 was very sharp up and down. 2011 was, okay, if you take off the spike over 1900 and just look at 1800, was about a year. And then there comes the cliff. It's, gold spiked in 2020. Here we are in early 2024. It's not quite 4 years yet, but that's completely different from those other ones. That, I think, is a plateau. If you're technical, I think that's a shoulder before the next head. And I think the breakout that we've seen, at least nominally, tells us that the head is coming. And then as a fundamentalist, not really as a TA, as a fundamentalist, and I think Adrian would agree with me on this, rate cuts alone are bullish for gold. If I'm right that we're due for a hard landing, I'm still in team hard landing. That's very bullish for gold. And then on top of that, we've got central banks buying hand over fist. And we've got two hot wars, not one, but two hot wars, either of which could turn into World War III. So there's a lot to be very bullish about gold here. And I think the underperformance of the stocks is an absolutely spectacular opportunity, because you don't have to risk your money on some fly-by-night junior that may or may not discover anything at all. There are great companies of the, well-known names that are on sale. And there are up-and-coming names, there are, new companies that are just hitting it out of the ballpark, and they're still relatively on sale. So this is maybe not shooting fish in the barrel, because it's still quite easy to make mistakes. There are many, many, to use Doug's phrase, crappy companies out there. But the good ones are on sale as well, or at least relatively on sale. It's against my religion to buy anything at a 52-week high, but there are plenty of stocks out there on sale. And I do see this as a terrific buying opportunity for those new to it, who missed it before, or those in already. If you're not all in, I think this, I'm not saying to go all in. I'm saying if you're not all in, there are opportunities to deploy in this space. I love it.
You can't have always hedging yourself just a little bit, can you?
Well, if you get a once in a lifetime opportunity, which may or not even be in the space, maybe it's your dream house or something. You don't want to be so all in that you literally get a once in a lifetime opportunity and can't take it. That would be agonizing. So I can see, if in a bullish scenario such as I have right now, I can see reducing my cash position to maybe 10%. Maybe if there were just bargains I couldn't resist, less than that, headed towards 5%. But I can't imagine ever being completely all in, because, okay, in my life, I only have one lifetime, but I have had one maybe opportunity that was of that sort, a once in a lifetime. And I bungled one because I was illiquid. And so if I do get another one, I sure don't want to have a lack of cash to take advantage of it.
Yeah. Can I just ask you, well, first of all, we'll talk a little bit about values, because valuations, but let me just ask you one thing you said at the beginning. If your stocks haven't moved yet, maybe you should re-examine them. And I sort of, in theory and in general, I agree with that 100%. And the same holds in reverse, of course. When a stock doesn't go down, when the sector is weak, that's maybe a sign that you've got a good company, not that you should get out of it as soon as you can. But, it's really only been the last couple of months that the stocks have really started to move, right? If you look from, I pulled it up on my Bloomberg here, you can't see it, but if you look from December, so you just look at this year, gold is well outperforming the gold stocks for this year. It's only from the end of February.
Yeah, no, and I get it. And that's the opposite of what, long-suffering gold bugs who get into the stocks. That's our whole reason for bothering with these stocks, is that they're supposed to give us leverage to the underlying commodity. Any resource speculator, right?
This month.
Right. So like, what's up with that? Is the market broken? I absolutely understand the question, and I've given you a long-winded answer for why I think that is. But you know what? At the end of the day, if let's just say, okay, I mean, not to quote The Princess Bride too much, but it's inconceivable to me that if we get a real all-time high, that the gold stocks won't move. We're talking north of $3,400 an ounce in the gold dollar exchange ratio. I cannot conceive of an come on this planet where that would not move the gold stocks.
Well, I don't think we have to go that high.
But let's just say that JP Morgan or Citi is right and it's 2,300 by the end of this year. Even the mediocre gold companies should be able to make money at these prices. The better gold companies are going to be printing cash. And you know what? If their share prices don't respond to their actual business getting better, then share buybacks could be an answer, or they could just freaking go private at some point. If the market, like conceptually, theoretically, if the market just will not reward them, no matter how great they're doing in reality, then you could say, fine, well, we'll go private. Now, I don't think that will happen. And I do think that it's reasonable for the market to be skeptical about this, given the profligacy we've seen of the majors, the balance sheet blowouts, the acquisitions just to get ounces on the books, a number of sins that I've heard you talk about, Adrian, in the past. So again, it's like the thing with the expectation that, and the reason for the gold stocks to be leading gold down, the recency bias in the history of gold, it makes it reasonable for people to look at the charts and be nervous. It's also reasonable for gold stock investors to remember what the majors did in the last big run up and be skeptical about their ability to deliver. So we'll just have to see. Again, that's one reason why you can't just throw darts at the board here. You want to look at companies that are actually delivering. And if you've got a quality operator, and I'm not going to name names, but people have heard you name them before, Adrian. And so, if you can look at a quality operator, you can see that they're delivering. You can see that they're keeping their costs under control, or their costs, maybe they've gone up, but not as much as gold has, right? That company should make more money. We should be able to see it. The proof will be in the pudding. And I think you can make money there, if nothing else, then through share buybacks, dividends, the capital appreciation isn't the only way to win here.
Right.
Adrian, there's a couple questions on this vein. I don't know if you want to jump into them right away.
No,
I think.
Go.
So Donald asks, he says, as you all know, the gold miners have trailed the performance of the commodity. Don't you think at some point investors will start to recognize the improved profitability of miners due to the value of their commodity and the increased value of the gold in the ground? I think
that's just what I'm saying.
Yeah.
What I'm saying is, though, that there's a history of underperformance. Yeah. So you can't just say, oh, gold's up, the miners are going to make more money.
Yeah.
It's a show me, don't tell me kind of thing. But we will see that. Like this quarter, I mean, well, actually last quarter was pretty good, but this quarter, what is the gold price averaging? Here we are almost at the end of March, and we're going to average what, something around 2,100 for the quarter.
Yeah.
I don't have that number in front of me, but if the better companies can't deliver in a quarter like this, then maybe my thesis changes, and I don't want any producers at all, and I only look for exploration stories or takeovers or something like that. But they should deliver in spades.
Yeah.
And investors should see that. And by the way, the timing here, this isn't a promise or a prediction. I'm just saying the timing here could be beautiful if I'm right about the hard landing, and this summer the economy really starts falling apart, the cracks in the labor market grow wider, Wall Street starts worrying. If at that same time, when people are starting to worry about earnings, the gold sector starts posting improved earnings, it could be that shining light in the darkness that just attracts a lot of attention. There's flavor of the day potential here if they deliver. But the point is, we need to see them deliver. That actually hasn't happened yet. The gold dollar exchange ratio alone is not enough for us to say, oh yeah, they're going to make lots of money. They need to prove it first.
Sure, and I think you just sort of hinted at something there. Part of the reason that gold stocks are not getting much attention is because other sectors of the market are doing so well.
It's hard to compete with NVIDIA, right? Yes.
Well, and to be fair and to try to be as honest as I can with the audience here, I think this is something where we can say the world has changed on us. I remember when, I was in diapers and Doug Casey taught me about speculation, bouncing on his knee, right, many moons ago. And, one of his primary Doug Casey-isms was that we like these crappy little junior mining stocks because they're the most volatile securities on earth. And there's alpha here that you just can't get anywhere else. Well, that was before Bitcoin. If you're seeking alpha and you're not just a speculator, but you're a gambler and you're willing to buy low and sell high and ride the volatility, it's simply a fact that Bitcoin delivers more volatility than gold ever has. If I was just
It's a
watching
complete and utter speculation, and that's fine. There's nothing wrong with that.
I was just watching something on the Hunt brothers, and that day that they got smacked down with that margin call, silver fell, was it, I remember if it was 13 or 31% a day. I think it was 13% a day, which for a commodity, for a metal, to fall 13% in a day was a record that still hasn't been broken. For Bitcoin to fall 13% a day, that's just, another tricky day in the
Day at
market
the
for
office.
Bitcoin. So I'm not trying to hawk Bitcoin here. What I'm saying, though, is that this source of volatility, if your MO is to play volatility, there is an asset class out there that's more volatile than junior gold stocks or junior mining stocks. That's just a fact. And NVIDIA, and so, I mean, holy cow, where companies as big as Apple and Meta can double in a year, you got to ask yourself, do I need to bet on crappy little mining stocks when the biggest companies in the world are, showing volatility like junior miner? So I'm not trying to scare everybody away. I'm just admitting these are facts out there. So and I'm not a technologist, did I think Meta was going to double after Zuckerberg went all in on the metaverse? No. Right. And now he's backtracked and the stock has doubled on the year of efficiency. What the hell kind of reason for that is, everybody can promise the year of efficiency, but easier said than done. But the market went ahead and gave him credit for it. So crazy markets. And here's the thing. I think a lot of this volatility, though, may not last forever, to the degree that we've got things like NVIDIA happening and Bitcoin happening because of the insane money printing and all the stimmy checks. I mean, the literally trillions and trillions of dollars that have been pumped into the economy since the COVID-19 lockdowns, never mind what was done before. Yeah. If all that money had to go somewhere and if people got paid not to work and suddenly they had a lot of cash to speculate with, then it makes sense that the most volatile, the most speculative assets out there, I trip over that word because I really think of speculation as a discipline thing. These are really gambles in my view, rather than speculations. But if you can gamble on the markets with money that you can afford to lose, the most high stakes, most attractive to people like that assets are going to attract a lot of attention. How long can that go on? Well, you know what? If this recession that I think is happening this year sends out the free money helicopters again, it could keep going on even longer. I'm not saying it's about to end, but I don't think that's a story that ends well. I don't see how real companies in the real world that have to deliver products and services to real people on Main Street, not just the promoters on Wall Street. I just don't see how hype and fantasy and easy money can substitute for sound business practices in the real world forever. That there has to be a day of paying the piper, I think.
Yeah.
I just don't know when that is,
Let me just jump in with a question here, because you talked about the hard landing a couple of times. And an anonymous attendee asks, won't resource stocks suffer in a hard landing, or is that already priced in?
No, it's not priced in. Yes, most will, but let me put it this way. Most resources will, because, gold and silver are money.
Yeah.
And everything else is just a commodity, in my view. They're commodity money too, but gold and silver are monetary metals, and I think they respond differently. I've been called Darth Silver by silver fans because I've been less enthusiastic about silver's trading action since 2020, when it never did catch up with gold in that bull market, which is a fact. Throw tomatoes at me if you want, but it's still a fact that silver has always caught up with gold in a bull market at the end, except this last time. And that's a significant point. But anyway, it's acting like money in the war in Ukraine, the latest war in the Middle East. Silver acted like a monetary safe haven metal should. So I treat it as gold still, but everything else is an industrial or an energy mineral. And it's the sort of thing that sells off going into a recession, with the exception that we just talked about is the other yellow metal. And I'm not saying, let me be clear, I'm not saying that uranium is recession proof. if there's a real hard landing, there's a shock on Wall Street and people really pull in, you know, one use of uranium or nuclear power is aluminum smelters, which consume a lot of energy. And so it's not immune to an economic pullback. But nuclear power is 24/7, 365 base load energy. It's the kind of thing that you use to power hospitals and airports and things that you cannot have the lights go off on. And that doesn't go away in a recession. And even in a recession, if you decide, you know, maybe we'll go visit grandma every other weekend instead of every weekend, you know, you're going to drive less, you're going to consume less gasoline. Sure, that happens. But you still want the lights to come on, and you still want that hospital and that airport to have energy. So I do see uranium as separate, and it's already in supply deficit. And whether there's a recession or not, the countries that are building nuclear power plants as fast as they can, right? The BRICS countries, China alone has scores of these things under construction.
150
They're going to
in the
need
next
those
couple of
pounds
years or
whether there's a
something?
recession or not. Sorry, Rich, go ahead.
I think China's 150 in the next few years or something.
Yeah, and they have plans for more. I mean, it's you know, they have. I mean, we think we've got pollution problems in the West, and there's a scare about the climate change, whatever you believe about that or not. You know, they have people dying because of smog. I have, you know, it's been a while since I've been to Beijing, but I remember just outside of Beijing and traveling in the provinces, you'd fly in somewhere, you could smell the sulfur in the air as the airplane was coming in to land. In the bigger airports, you could see the smog inside the airports. They were so big, you could see smog inside the building. So they've got a real problem. They know it. You know, they were one of the first to pause and consider the implications of Fukushima and then keep right on going with their building, right? So this is a story that I actually don't think that another Fukushima would necessarily derail it. The need for clean 24/7, 365 power is so intense that I think, you know, another Fukushima would be scary, but people recognize that it was the tsunami that killed everyone. That, you know, the number of deaths by radiation from that plant is actually zero. There are no confirmed deaths.
Right.
You know, and people say, oh, well, 30 years from now, there'll be three-legged babies or something. I don't know. But you know, right now, it is the urgency for more electricity is so strong that I'm not convinced actually that another Fukushima would derail nuclear energy the way it did last time. I think it'd take a Chernobyl scale event. And so, sorry, I don't want to drag the conversation back to uranium again. The answer to the question is yes, you're right. Basically, everything commodity sector will take it on the chin in a recession, except gold and silver, which are money.
Right.
And I think uranium is more immune, more protected, and could even go up despite the recession.
Let me just jump in on that, if I may, just to, you know, I think it's important to realize gold and silver, as Lobo says, are money. They're different from other commodities. Remember, markets are forward-looking. And so it's not a recession that is good for gold. It's the probable reaction to a recession, namely easy money or helicopter money or whatever, that is good for gold. So the markets are forward-looking and they look ahead. Now, you know, if you look, I'm a historian by training, look at all of the recessions, 9 recessions since the end of the 1950s, and you see that in all but one of those recessions, gold was up. That's history, and as Lobo likes to say, that's a fact. So we can forget the theory for a second and just look at the last 9 recessions, and gold has been up in every single one, and the exception is 1980 when the European banks were dumping their gold, if you remember. If you look at the gold stocks, in a clear majority of recessions, the gold stocks were up during the period of a recession. And in all cases but one, the gold stocks outperform the S&P. So again, the history is fairly clear. And again, if you look at just the average, then it's very clear that you want to be in gold stocks during a recession. That might seem counterintuitive, but it's a historical reality.
So Sorry,
Can I
before
play
you move on
devil's
from that, let
advocate on
me
the
throw in
recession?
another point that I think is a really important distinction to make here, and that is a lot of people conflate recession with market crash. A recession may cause a market crash, and in a market crash, everything gets whacked, right? Even gold. Initially, that liquidity squeeze, margin calls, people sell what they can get a bid on. And we've seen this every time, you know, that you get this, and then you get that screaming back again as soon as the liquidity passes. But I just want to put that out there because people will say, well, gee, you know, in 2020 or 2008, you know, gold sold off. Well, that wasn't the recession. That was the market crash that did that. Now,
Sure.
if this recession, if it happens, and if it causes a market crash, then there will be a buying opportunity there. But it may not. Markets are forward looking, as Adrian is saying, and markets have been trained to expect the Powell pivot, you know, the Fed put, whatever you want to call it, that easy money, the response to the recession. We saw in 2020 circumstances that any sane person would have thought would have driven the markets much lower. You know, the pandemic and all these shutdowns, all these crazy things. But the easy money overcame that and the markets went nuts. You know, in a horrible situation in the real world, stocks went up because of this thing that Adrian is talking about. So it's not, we'll have to see. We don't, even if we're right about the recession, it's not necessarily so, particularly with markets trained like Pavlovian dogs to expect the easy money. It's not a guaranteed thing that there will be a crash.
Yeah, I was going to say, I want to play
make it melt up.
I was going to say devil's advocate here on the recession. I mean, the one thing is we're in an election year, and I think that's very, very rare. Nobody wants to do anything to tip over the apple cart in the middle of, you know, votes coming in and being tallied. So I don't know that we're going to see a recession. On top of that, we've got, maybe not this year, maybe next year, but we see Powell, after Congress just spent another 1.2 or committed to spend another 1.2 trillion of money we don't have, and inflation's ticking up. Powell's promising 3 rate cuts this year. I mean, that doesn't sound like, you know, we're going to let this thing fail.
That's a good contra case, but let me put it this way.
Yeah.
If the recession should happen, if the labor market weakens, if bad stuff is happening that should take the economy into recession, and the powers that be intercede to make it not happen, that will be very obvious. The man behind the curtain will be absolutely, there will be no curtain there. People will see it. And B, if they're doing that with inflation still not beaten, still well above the target price. Let's say they intervene. They see the recession coming, the writing's on the wall, and they send the money helicopters before the recession happens. That's basically what you're saying. It's an election year. We can't afford the recession. So let the money bazookas rip, or whatever metaphor you want to, you know, ahead of time. We're not going to let it happen. Well, A, it's obvious, and B, the inflationary implications, markets are forward looking. I don't think that's bad for gold at all. I think at that point, people say, holy cow, it's the 1970s all over again. You know, the Fed has not tamed inflation. You know, Powell is not Volcker, he's Burns. It's taking off again, and I think you'll see gold go nuts. So I don't see that as a bearish outlook at all. I see it as just a different way for the monetary metals to win.
Good point. Good point. You want to cover this other question, Adrian, from the anonymous attendee about pushback on the gold miner comment?
No, I was just looking at that. I don't know if I or Lobo, I don't know if we said something that was misunderstood.
Yeah.
The attendee says he wants to push back on the comment about the gold miner. He thinks the gold miners are fell to unbelievably low prices. I don't think Lobo and I disagree with that. Certainly for myself, I think I think there are very good reasons. I won't go on about it because this is, you know, Lobo's a guest, not me. I think there were good reasons why gold went up last year and the gold stocks didn't.
Mm-hmm.
And I would argue for most of last year until this year, really, if there was a mismatch in prices, it was gold that was mispriced. Gold was too high. But be that as it may, I don't think. Well, I'll speak for myself.
I think we must have been misunderstood. I was
part
of my whole spiel is that the gold stocks are an opportunity because they are undervalued.
They are incredibly undervalued now. And just to sort of, first of all, if you just look at price, and as we all know, price is not the same as value. Sure. But you know, look at Barrick. Barrick's $16 today. I mean, my goodness. It was $20 a year ago. It was $25 2 years ago. It was $30 3 years ago. So on a price, and then, you know, go back to 2011, it was even higher. So even though we've seen Barrick, and Barrick's the second largest gold miner, pick up a little bit, you know, it's still stupidly cheap on a price basis, but on a valuation basis, which is much more important, selling at its lowest price to net asset value other than the last quarter of 2015 since the 1990s. That to me simply doesn't make sense when gold is where it is, and when, despite costs going up, this is the other thing that's critically important to understand. Everyone's concerned about inflation, and every conference call you listen to of the senior miners, they're talking about their costs going up, but the costs are still, relative to the gold price, considerably lower than they were in 2011, in 2008. I mean, I remember very clearly from 2004 to 2007, despite the price of gold doubling, the margins didn't expand at all because the inputs went up. You look at 2011, the last time gold was at over $2,000, excuse me, oil was as $140 a barrel, not $80 a barrel. The Canadian and Australian dollars were both selling at significant premiums to the US dollar, not significant discounts. So the costs, whatever cost pressures there have been in the last 2 years, the costs are still low compared with where they have been in the past. And so the margins of the gold mining companies, again, as Lobo says, you look at this quarter, gold over 2,000, a lot of companies with all-in sustaining costs, we can debate just how all-in they are, but all-in sustaining costs of $1,350, and got, you know, actual operating costs for some mines of 900, 950. Those are very, very good margins that companies are employing. I mentioned Barrick and price of net asset. Look at Agnico, which would be my favorite of the big three. I know you wanted me to say that, Lobo. My favorite of the big three, but they are selling, again, other than the last quarter of 2015, they are selling at the lowest price to cash flow basically in their history. Again, doesn't make sense.
So we're agreeing with Anonymous. Maybe if we're not clear, maybe if he's still listening, maybe he can clarify his question, or maybe it was my point about if your stock hasn't moved, there's a problem. And
I think that might have been what it was relation to. And I think what he's saying is, you know, they were completely undervalued and they have moved up and they're still undervalued, but I think we're all in agreement on that point.
Which is an opportunity, I think, now.
Absolutely.
For any Johnny come latelys or anybody who just has more money to deploy. But I would stick to my guns on that. If you've got a stock that just hasn't moved, like, okay, like even using Adrian's example of Barrick, you could say it's undervalued, it shouldn't be this cheap or whatever. Barrick has had its setbacks, but the point is that Barrick's share price, it did respond to the higher gold price. If Barrick was doing the I'm falling and I can't get up thing, that would be a very big red flag. And I would have to disagree with my good friend Adrian, and we'd have to have like mud wrestling or something in Puerto Rico to decide who's right. Trial by combat. But the point is that the stock did still move. Like, so whatever Barrick's problems are, the stock did respond to the higher gold price. That's what I'm saying. If you don't see that in your company or something you own, the market is telling you to have another look. You can ignore me if you want. You can get mad at me because you love your gold stock, but Mr. Market, not Mr. Lobo, is telling you to have another look at that stock.
Right.
Yeah.
I agree with that.
All right.
Do you want to go, Rich, or shall I?
No, go ahead. It looked like you had a question. If not, I've got.
I'm actually going to just switch gears completely, if I may, because I wanted to ask you something before we run out of time. And I know Rich will get some of the questions that people are asking. I wanted to ask you this, Lobo. You've been in this business a long time. I'm a little older than you. I've seen you, if I may say this, I've seen you really grow tremendously from your very early days with KC. So I'd like to ask, and you've been in the business a long time, you visit sites, you talk to your subscribers. What is it, two questions really, what is it that makes a successful speculator? And then what are some of the lessons you've learned, particularly some of the things that people, the other side of it, some of the things that people do wrong?
Okay, fair enough. It's hard to put one trait, but maybe related traits. I absolutely believe that discipline pays. A successful speculator, you look at somebody like Rick, and I call him a loan shark, but a laser guided loan shark. You know, I call him that to his face, like he takes it as a compliment, because he's merciless. He's cold-blooded like that shark, or even a human loan shark. And that's what you need to be in this business. You can't fall in love with the stocks. You can't fall in love with the management of companies that, you know, you had some beers with in the high Andes, and you know, you looked at the stars, and, you know, but the gold wasn't there. It doesn't matter how chummy you got with them. You've got to be disciplined. We're all emotional. I'm not saying that you can't have emotions, but don't let your emotions make your decisions for you. And with that, skepticism is an absolutely cardinal virtue for speculation. You know, people come up to me all the time. Oh yeah, what do you think about this company? They're going to double their production next year. And I say, oh, that's great. How do you know that? Well, they said so. Well, of course they said so. You know, I mean, so no, I mean, with all due respect to our colleagues on the other side of the table in this specter, investors, audience, you must assume bullshit on everybody that's trying to sell you a stock. And then if you do your due diligence and you find out that it's not bullshit, that you're wrong, then you get surprised to the upside. You never get disappointed. You won't get hurt so much if you assume bullshit. Like, and I mean this literally. I'm not saying that they're not all necessarily lying to you, but everybody's gilding the lily. Even the best, most straightforward miners out there, they're not going to tell you about their problems that they have on the mine site or whatever, because mines have problems every day, all the time. You know, they'd never get any investors if they put on their website every problem they had every day, right? So it is your job, it's your responsibility as a due diligence guy or gal to assume bullshit and then do your due diligence and allow yourself to be surprised to the upside. You must be skeptical and disciplined when you approach this. Maybe that answers the flip side. I think, you know, besides the obvious, you know, corollaries of, you know, you can't fall in love with these things. You can't get wedded to a premise. You can't refuse to admit that when you've been wrong. I think actually the other thing that's somewhat separate from that, but related, is taking a step back even before you start. And I say this, and it sounds like mushy pop psychology, but I sincerely believe this to be true. The first step is to look in the mirror and ask yourself, what kind of investor am I? What kind, you know, what is my tolerance for risk? What interests me? You know, if I'm very interested in the monetary metals, well, I'll have more fun studying those MD&A from those companies in that space. Or if I'm fascinated by nuclear energy and the engineering there, and, you know, it'll be more interesting for me to study the uranium fuel cycle and get knowledgeable enough and be able to make better decisions there. Or if, you know, I love the electrification story and I'm all about copper and so on. Know thyself, I think, is a not just a 2,000-year-old platitude, but a critically important dictum here. You know what you're interested in, know what you're not interested in, know what your weaknesses are. Absolutely gauge your tolerance for risk. And if you don't really know the answers to this, ease into it. You know, make some small bets with some play money, and see if you've got the guts to average down when the story is better, but the stock is cheaper, or see if you have the discipline to take a 90% wipeout on some stock that you just got wrong, right? And you know, if you figure that out, you'll know where you are, and I think you'll have much better odds of doing the other good things. You know, having the discipline to see the trade through on a rational basis.
No, I think that's
really good advice.
Because I think some people, you know, obviously part of risk is you know, how much money you have, what your future needs for cash are, you know, what your obligations are. Do you have grandchildren that you are going to have to put through college, whether you like it or not? That's part of it. But the other part of it, as you mentioned, is just some people simply cannot accept volatility. And volatility is different from risk, of course, and there's plenty of both in this sector. But some people simply can't take volatility, let alone risk. And I've had clients who call me and say, I'm not sleeping. Well, if you're not sleeping, you shouldn't be in this sector, or you have too much in this sector.
Absolutely. I agree 100%.
Yeah.
And sorry, being able to fess up when you're wrong. I get people get mad at me. They ask me, what do I think about the XYZ company? And I give them my take, and they get mad. Oh, but I've met with management many times and I really trust them. And I think, well, fine, you can talk yourself into it. But here are the facts, right? They're not making money. They didn't do what they said they were going to do. Their costs are going up.
Yeah. Rich?
Yeah, so I've got some questions here. I'm not going to get through them all. I can see that already, but the question was, how much time in weeks or months will Lobo allow the gold stocks to move after the price of gold has gone up, such as now, before he gives up on any move?
I'm not sure I would put a time frame on that. Well, in the first place, they are moving now. So I think the question is a little bit
It's early.
Surely, yeah, or whatever. But okay, but let's say we go to 2,500. Like the time frame isn't the point. But let's say we have this breakout continues and we go to 2,500 over the next couple of months. If the gold stocks are not responding with gusto to a major breakout like that, which really should be making headlines. I mean, even mainstream media should be talking about that left and right. And where we are now, that's happening. Even Bloomberg, Yahoo Finance, where all they seem to care about is Chipotle and Nvidia. These places are talking about commodities now, and gold in particular, because records will do that, right?
Yeah.
So if that has no impact on the gold stocks, yes, I would reconsider my premises at that point. It's not a time frame, but
Yeah.
But we'll
Or
see.
reaction to the environment. Yeah.
Yeah, and by the way, if they start to move, there should come a point where they recover the leverage that we're looking for. Like if the gold stocks kind of start moving with gold and they just trade and they track gold, you know what? I could see selling all my gold stocks. Screw it. I'll just buy gold. Like, why do I need to take the risk of companies that can go bankrupt, that can have an endangered mosquito discovered on their only mine, or whatever, crazy thing happens? Why bother with that if they're not giving me leverage to the metal? If the metal itself, they can never go bankrupt. It can go up or it can go down, but it can't go bankrupt. The endangered mosquito can't bite it, right? So why bother?
Yeah.
If it's difficult for me to see that happening in this world. I don't think human nature has changed. I think when gold really starts exciting people, then they'll start saying, oh, well, how can I make more money? And then that money will flow into the gold stocks. That has happened. You guys are nodding. You know whereof I speak. It has always happened. If it doesn't happen this time, it'll be the first time, and I will have to recalibrate. But
and Lobo, just to add to that, I don't think it's happening at all right now. This is the weirdest gold market that I've seen thus far, because gold price basically consolidated for 3 years at $1,800 to $2,100 an ounce. And in that time period, everybody was waiting for it to go lower, to go lower, to go lower. Nobody was buying gold. It's too high. It's near all-time highs, right? But it was consolidating, not bumping its head on the ceiling. It was building the platform for the next leg up, in my opinion. But during that whole time, central banks are buying. High net worth individuals are buying because they weren't being hurt, by the current economy. The middle class, the investors, are not in this market. In fact, they're exiting this market so they can sell that liquid asset to cover 20% credit card debt. Okay, we have clients doing that right now. They are not investing in gold, and they still think the price is too high.
Sorry. Let me ask you about that, because a lot of people have been looking at the outflows from the ETFs.
Yeah, I think that's part.
So that one seems obvious. Like central banks, if they're diversifying out of the dollar, they don't want no paper substitute. They want physical, right?
And gold's a tier one asset now. So,
but that's a different thing from mom and pop. And in your business, you have access to retail. Are you telling me that actual gold bug type people who've saved and stacked for years are starting to sell because they have to?
I actually had one client call in and say, I am so sorry that I have to sell this gold. I promise you I will get back in. And I'm like, it's your goal, not mine. I mean, you don't have to apologize to me. I'm here to make a margin one way or the other. If you're buying or selling, I do both. But they're like, I'm so sorry, I will get back in, but I have to take care of this credit card debt,
Yeah.
which is sitting
Wow.
at 20%. That's very real. And I don't think Powell understands what's going on in the middle class right now. I really think he's lost touch.
Or he does, and he can't admit it.
That could be too.
If he says, the brown stuff's hitting the fan, everybody head for the hills, that's going nuclear on the economy.
Yeah. So I just think it's a very weird market. And on that note, follow-on question for Darth Silver. Would you buy more silver than gold now?
No, not yet. So you can throw the tomatoes at me, but even a diehard uber bull in silver will tell you that silver always lags gold and then more than catches up in the end. So if that's the idea, well, and we've been consolidating for 3.5, 4 years, and therefore if the next big move is up in gold, that's a new market, a new bull market. Why would I pile into silver at the beginning?
Yeah.
And even the bulls say it'll lag at first.
Yeah. Gold's got to establish it first.
And on top, and here comes the Darth Silver thesis. At the same time, we've got silver's larger industrial side, which has clearly been a factor. I mean, just look at the charts and the numbers. I think it's undeniable that silver's greater use in industrial applications. It's a win for silver in some cases. There are scenarios in which the economy's booming, we don't need safe haven assets so much, but silver does well because it has that industrial demand as well. So this isn't an all bad thing that silver has this other aspect. But going into a recession, so if in the first place, it's a new bull market, silver's going to underperform at first anyway. You've got that. Plus, you've got the industrial use of silver and the demand goes down in the recession. You've got that as well as the other. These are reasons to not be jumping the gun into silver. Now, okay, if you're a very patient and disciplined speculator, and you know that, okay, even if silver drops 50% from here, it's going to go up 500% later, and you can ride that volatility out, maybe you're okay. Buy your silver now or your silver stock now. Actually, the silver stock may not survive that downturn, right?
Yeah.
So these things are different. But let's say you pick the best silver companies that are going to be there after the dip and it goes up again. Well, in the first place, why would I buy now if I might be able to buy it cheaper in that scenario? And B, really the main thing is very, very few people have that discipline. Few people are as cold-blooded as my good friend Rick Rule, right? Most people will freak out. They'll be pulling their hair out. I mean, the hate you see for silver right now is indicative of how few people have the intestinal fortitude to see that trade through. So my view is not anti-silver. It's just, look, the odds favor at the very least silver underperforming at first and possibly much better buying opportunities. If those are the most likely outcomes, there's no hurry to buy, and I could benefit actually by buying lower in the months ahead. So I'm not anti-silver. I'm just saying, discipline suggests to me that it's not the first thing I'm going to buy. So this year, my focus is gold and uranium only.
Okay.
No oil, no lithium, nothing. Just gold and oil.
Laser focused.
Sorry, just gold and uranium. Sorry. Laser focused wolf, right?
You want to add to that, Adrian?
No, that's fine. That's fine.
Okay. CCS, I think you just answered CCS's question about would it be prudent to back up the truck for exploration stocks now, but I think you just covered that because you could potentially miss that downturn.
Well, if it's silver, then yes.
Yeah.
And by the way, you also have political risk. It's one of these weird things. It just so happens that a lot of the best silver deposits in the world are in countries that are either uninvestable or headed in that direction. So it's hard to find a good silver stock that, let's say I'm wrong and silver just goes vertical next week. But the stock you bought is in Mexico and the president succeeds in banning open pit mining. And there goes your big open pit silver project, right? Yeah. So it's tricky. I think it's actually, good news particularly for Mexico. If Darth Silver is right, and it's prudent to wait a few months to see how silver plays out and whether it's going to lag gold at first, Well, we'll have that election in Mexico. I think it's June. So we'll have a much better idea whether or not Mexico is going to go whole klepto on us or not. And, we'll see how these things go. So, yeah. But gold juniors, no, I wouldn't wait. That's the top research priority on my part right now, is to look for the juniors that have got the goods and where can I deploy?
Gotcha. The other thing about silver I think is important to mention is that, as you know, there are very, very few good quality, pure silver mines and very few silver companies that are primarily, let alone exclusively, silver. Many of the companies we think of as silver companies, like Pan American Silver or Fortuna Silver, produce a lot more gold than they do silver. They will probably react when silver goes up, because when, Joe Doe goes to his broker and says, hey, I like silver, what silver stock shall I buy? He's going to say Pan American or Hecla or Coeur d'Alene or one of those, quote, silver companies. But I think it's important we realize that many of these companies produce a lot more silver and even more zinc, don't tell anyone, than they do silver.
Well, by volume, certainly. So when you say silver primary, we mean by value. But yeah, if you say, pure silver, I'm not aware of any mine that could be considered a pure silver mine.
Oh.
The purest silver mine would be a silver gold project with very little gold. But I'm not aware of any silver mine that doesn't produce at least some gold in there.
Right.
Or, it's galena or sphalerite, right? And they're producing a base metal concentrate, but that the base metal is such a small amount of the value that, if the value is 95% silver and 5% zinc or lead, you don't care what happens to the lead or the zinc, right?
Right. But I'm saying there are relatively few of those companies.
Right. But yes, but even that, you're still actually pulling more lead or zinc out of the ground than you are silver by volume.
Yeah.
Gotcha. I think
Sorry, I'm nerding out. Yeah, go ahead, Rich. What's next?
Yeah, I think I have time for one more question. Then I want to go and take the time to get parting thoughts. And I do want to have you just share briefly with our listeners, Lobo, about your very unique and interesting service called My Take. So I do want you to explain that a little bit, and we'll have more detail on that in the follow-up email, but I want you to touch on it a little bit. So I want to give time for that. So the last question, I apologize for the ones that we didn't get to. We can always try to get back to these afterward if we can. But what happens to resource gold stocks if rates go up instead of down? Either Powell deciding to hike due to inflation resurging or cutting at the short end, which could lead the bond vigilantes taking the long end higher.
Right. So it depends very much on the reason. If we're hiking because the economy really is booming, right? It's happy days again, and therefore higher rates are necessary, then maybe in that environment it's less bullish for gold because it's happy days again. I don't think that makes the central bank buying going away. It doesn't make the safe haven for geopolitical reasons go away. I don't think it's necessarily as bad news for gold as one might think. And Adrian can confirm this. There are many times where we've seen rate hiking cycles actually be good for gold. And 2004 really sticks in my mind as a case in this, because usually when you're hiking rates, there's a problem.
Yeah.
So, that the scenario that I just outlined, where we're hiking rates because everything is fine and everything's so robust that we can afford to have these higher rates, and or we should because we don't want the economy to overheat. That's. I think the chances of that are probably slim to none, as Doug would say, and slim's out of town. So I think the reason why we hike this year, if that happens, is because they realize, holy crap, we haven't got inflation under control. And that holy crap moment, sorry for the technical jargon there, that's very good for gold. Because that really starts to look like the 70s. Okay, they didn't cut and then reverse and have to raise again, but they paused. They talked about cutting. The guidance right now is clearly, yes, we're winning inflation. We're going to be able to cut. So I think even now, if they flip-flop and they go to raising rates, they can say, oh, well, we never cut. We just paused in our hikes. But nobody's going to believe that. Everybody, the cat is out of the bag. They've talked about rate cuts. even just last week's meeting left 3 rate cuts on the table for this year.
Yeah, they doubled down,
Sure. Which is gone already, or a quarter of which is gone already, right? So I think higher interest rates by the Fed this year most likely would be for bad reasons, and that would be good for gold. And we might see a 2004 type coincident there.
I can't argue with that. So we'll start off with you, Lobo. If you could, just a parting thought, just kind of encapsulate your big message for tonight, but also before you go there, tell us a little bit about My Take and what this is. It is not a newsletter.
Right. Well, for the people who haven't tuned out already, let me also first say that I do Q&A weekly in my free letter. If you sign up for my free letter, it's called Speculator's Digest. You can go to independentspeculator.com, and I have a free weekly letter. It exists only as email. It's not on the web anywhere. And you get 1 email per week. I can't promise that you'll like everything that I write. I can't, but I can promise that I will not spam you with a flood of daily advertisements. I hate that. You get 1 email per week, and I do answer, even from non-paid subscribers. I answer Q&A every week as much as time allows. So if we didn't get to your questions tonight, you can send them to me that way, and I'll try to help if I can. As far as My Take goes, it's the most misunderstood thing I've ever done, because it really isn't a newsletter, or rather, there is a monthly newsletter, but it's a brief bit of context. It's kind of an update for the markets. The idea for My Take is that for 20 years now, people have come up to me at conferences or even on the streets in Vancouver and said, "Oh, hey, Lobo, what do you think of this company?" Or "Here's my portfolio. What do you think?" Like Rick with his portfolio ratings. People come up to me all the time. And I am not, unlike Rick was, I am not licensed to dispense advice on an individual basis financially. I could go to jail for doing that. I can only express my financial opinions via my newsletter. So people will come up all the time and say, "What do you think about this?" Or "I'm really worried about this." And I wanted to help them, and I couldn't without risking jail time, right? I'm not supposed to answer those questions one-on-one. So My Take is my answer to that. There's no portfolio. It doesn't include my stock picks. It is a database of hundreds. We're pushing 800 companies now, all resource stocks, where I evaluate them. And I now have a team. It's gotten big enough that it's not just me. I have a team that helps me with this. But the evaluations are mine. The initial study, and then if there's anything major or anything that might change the story, that comes through me. Routine updates that I've trained the team well enough now that they're starting to pitch in with that. If they know what I'm going to say, they don't need to bring that to me, and I trust them to do that. The point is, if you could use a second opinion on some of the stocks in your portfolio that you're worried about, My Take can help you with that. I can answer that question through My Take if it's covered, or if there's stocks that you're looking to buy. If I can't tell you, this is what you should do personally, you can use the My Take database. It's sortable. You can sort by, say, junior producers, gold, that have a thumbs up. And each stock has a clear thumbs up or a thumbs down. So you could sort by the kind of company that you want, and you could generate your own shopping list based on that. So there's a lot more to it, but I don't want to go on too long. The main point, though, is that it's a sliceable, diceable database that helps you answer questions, and we take requests too. So all these years that I haven't been able to help people, one-on-one, if I got licensed and I had to, set up a consulting business, I'd have to charge people like $5,000 an hour or something to do this. Instead, through the database, I can help people not on an individual basis exactly, but in a customizable basis that helps individuals make their decisions. And I get feedback from clients all the time. In the first place, people sign up and they say, "Oh my God, I had no idea like how much information there is here, how much value there is here." And then B, I get people all the time, I won't make a decision without checking My Take first. This is incredibly useful. Or if you have a thumbs up in My Take and Adrian says it's good, well, then I'm sure it's good, right? We have 2 votes for it, or Brent Cook or somebody else. Like, people will use it in that way. And this is a way that you can hire me to be your due diligence guy, even if you couldn't afford to hire me one-on-one as a consultant.
Yeah, I think, I find your take I find my take very valuable.
Don't change the name on him.
Yeah, just so there's no misunderstanding. Yes, you give a very clear thumbs up or thumbs down, which is, just snapshot. And I think it's in green or something, but it's very clear. But I think it's important to realize you also give very good explanation of why you like, why you don't like, or why you're concerned, or what could go wrong, or what could go right.
Yes, pros, cons, the bottom line. I have seen people walking around PDAC or Vancouver with my take on their iPad. Like they'll come up to a booth and they'll look, oh, what does Lobo say about this? And then they'll ask those questions. I don't know. I mean, like
It's got to be a good feeling.
I have seen people in the field with my take on their phone. So it's, we don't cover them all, but I think, I'm beefing up the team. My ambition is to become like the Bloomberg of mining. And, the universe is large, but, there aren't that many companies that are actually doing anything interesting. If we reach, 1,000 or maybe 1,500, I think we'll probably have all the mining companies that are actually doing work, not the shells and all that other stuff. And you know what, sometimes I don't get it. I don't trust the team or something like that. It gets a thumbs down and the stock goes up. I don't promise that I get everything right. My promise here is that it's independent. There is no amount of money any company could pay me to give them a thumbs up when I think they deserve a thumbs down. So, it may not be perfect, but it is independent, and I work for you.
Good stuff. Good stuff. So your one take, what is the one thing you want people to not my take, but you want people to walk away from here tonight with?
This is the year of the 2 yellow metals. Sorry, silver bulls. I'm not anti-silver, but I really think as a resource speculator, this is the year to focus on gold and uranium. And the thing of beauty to me about this is that it's a self-hedging portfolio. If I'm dead wrong about the hard landing and everything is happy days and Israel and Hamas kiss and make up and Putin decides to just go home and everything is fine in the world and gold just goes to sleep for the next 5 years, in that world, my uranium stock should go nuts. But if I'm right, and there is the recession and gold goes nuts, maybe that hampers uranium a little bit, but that's not even a sure thing. Actually, my base case expectation is that both yellow metals will do well this year. But if I'm wrong on either side, one of them hedges me against the other. And I think that's a thing of beauty.
Nice. Adrian, how can people reach you? Now, everything that Lobo talked about, my take, we're going to have that video and a link in the follow-up email tomorrow with the full broadcast and the Q&A. Adrian's contact information will be in there as well. But Adrian, how can people get a hold of you and what's your walking away point tonight?
Yeah, well, it's easy. adrianday.com is the way to get hold of us. As Lobo mentioned, I'll be perfect. And as we say every time we do one of these, if people want to send me questions, I'll do my best to answer whatever questions we didn't get to tonight. And that would be at assetmanagement@adrianday.com. But that'll be in the email tomorrow. I think my takeaway message would be, I'll just focus on the gold stocks. I think the gold stocks are incredibly good value right now. And all of the factors that I've been talking about for the last year that would lead the gold mining stocks to go up, we're getting very close to that point. So I think, I don't, like Lobo, I don't believe in 100% or certainly don't take home equity loans to buy gold stocks. But this is really a time to go to your maximum weighting, in my view, on the gold stocks. And the other thing I will say, generally, yes, I'll leave it at that. There's good value among the largest miners, among the royalty companies, among the exploration companies. There's good value. You just need to really be, pick the best, be selective.
Sounds good. And from our standpoint, I think everybody knows how to reach us. info@assetstrategies.com. We have a special for those that are listening, and we're going to go out to all the registrants tomorrow. We believe very strongly in gold right now too. My takeaway point, I've said it earlier, I've said it for a year now. Gold at all-time highs is dirt cheap right now. And in order to help you get that in your portfolio and build up your allocation, we're offering a deal for those listening. Gold bars, you call into us, mention the webinar, $69 over spot. No quantity, issues. You buy one bar, you're going to get it $69 over spot. And every time you buy three, we're going to send you a Silver Eagle with it too. Because silver will be rising again, kind of like the South. So that's my thought, my takeaway. The last thing I wanted to say, other than, thank you both gentlemen for another wonderful exchange. Lobo, really appreciate you coming on and spending the time with us and our readers, sharing your experience. But I wish everybody a very, very happy Easter, and look forward to seeing you on the other side. Don't forget, May 7th, Peter Gavelti, that's a Tuesday night, and he'll be our next guest. And thank you all.
Thank you. Thank you.
Good night all.
Have you turned off?